Friends, good afternoon. I am going to tell you another option strategy. I already covered bear call spread. Now I am going to cover bear put spread. This is also a option strategy. The time frame can be used 15 minutes. Preferably you can use swing trading also. Trade setup: stock market should have movement in bear or bull direction. Trade with primary trend and select the stock as with good quality of value. Trading preferred time is 9:20 a.m. to 11:30 a.m. and 1:40 p.m. to 2:45 p.m. This strategy should be avoided in range bound and sideways market. So let's go ahead with bear put strategy. Before I start, I request you to subscribe the video. In case of not subscribed, you will be getting more training that is going to help you a lot. So and share to your friends who want to build up their career in financial market. Option is a good way to earn money because in option limited loss and unlimited profit. So this is the basic definition of option, but for knowing the option you must aware of technical analysis and some indicators and patterns and price action also. So what is a bear put spread? Bear put spread is a type of option strategy where investor or trader expect a moderate decline in the price of security asset. A bear put spread is achieved by purchasing put option while also selling the same number of put on the same asset with the same expiry date at the lower strike price. The maximum profit using this strategy is equal to difference between two strike price minus net cost of the options. So let's go ahead. What is the outcome? So the outcome of bear put spread is bear put spread is an option strategy implemented by bearish investor who want to maximize the profit while minimizing the losses. Bear put strategy involves simultaneous purchase and sale of the put on the same underlying asset with the same expiry date but different strike price. Bear put spread net profit when the price of underlying security decline. So there are three outcomes from this strategy. So I have shown you the diagram of bear put spread. So you see y axis rupees is there, then 300 and minus 200. Then you see the price, how the price is fluctuating 35, 38 and 40, and how it is moving. You have to correlate with the example. I will show you the example in the last of the PPT. So what is bear put spread construction? So in bear put spread, buy one ITM put and sell one OTM. So buy OTM put. So by shorting the out of the money put and the option trader reduce the cost of establish the bearish position but forgo the change of making a large profit in the event that underlying the asset price plummets. The bear put spread option strategy is known as the bear put debit spread as the debit is taken upon entering the trade. So what is limited downside profit? To reach a maximum profit, the stock price needs to close below the stock price of the OTM puts on the expiry date. Both options expire in the money, but the higher strike put was purchased will have higher intrinsic value than the lower strike put was sold. Thus, the maximum profit for the bear put spread strategy is equal to difference in the strike price minus net debit taken when the position was entered. Formula for calculating maximum profit. So maximum profit equal to strike price of long put minus strike price of short put minus net premium paid minus commission paid. Maximum profit achieved when price of underlying is less than or equal to strike price of short put. So what is limited upside risk? If the strike price rise above the in the in the money put option strike price at the expiration date, then bear call bear put spread strategy suffers a maximum loss equal to net debit taken when putting on the trade. The formula for calculating maximum loss is given below. Maximum loss equal to net premium paid plus commissions paid. Maximum loss occurs when the price of underlying is greater than or equal to strike price of long put. What is the break even point? The underlying price at which break even is achieved for the bear put spread position can be calculating using the following formula. Break even point equal to strike price of long put minus net premium paid. So let's go ahead with the example. I have already shown you the figure. So this is purely linked with the bear put spread strategy. So let's say suppose XYZ is trading at 38 rupees in June. 38 rupees in June. An option trader bearish on the XYZ decide to enter a bear put spread position by buying a July 40 put for the 300 and sell a July put 35 for rupees 100 at the same time, resulting a net debit of 200 rupees for entering the position. The price of stock subsequently dropped to 34 rupees at expiry. Both puts expire in the money with July call 40 bought having rupees 600 in the intrinsic value and the July 35 call having 100 in the intrinsic value. The spread would have a net value of 55. The difference in the strike price deducting the net debit taken when he placed the trade, his profit is 300. The maximum this is the maximum possible profit if the strike had rallied to 42 rupees. Instead, both options expire the worthless and the option trader loses the entire debit of 200 taken inter trade. This is maximum possible loss. So friends, let me summarize. I have covered you the definition, then the outcome of bear put spread, how this has been constructed, formula, then break even point, then the example. And let's go ahead further with the advantages of bear put spread. So I have shown some advantages of bear put spread. I will cover. So the main advantage of bear put spread is that the net risk of the trade is reduced. Selling the put option with the lower strike price helps offset the cost of purchasing the put option at the higher strike price. Therefore, the net outlay of capital is lower than buying a single put outright. Also, it carries a far less risk than the shorting the stock securities, since risk is limited to the net cost of the bear put spread. Selling a stock short theoretically has an unlimited risk if the stocks move higher. If the trader believes the underlying stock or security will fall limited amount between the trade date and the expiry date, then bear put spread could be an ideal play. However, if the underlying stock security falls have a greater amount, then the trader giveth the ability to claim the additional profit. It is the trade off between the risk and potential reward that is appealing to many traders. So friends, this is from my end. So you go ahead with this. I have told you more than 13 option strategies, then basic of the option, implied volatilities. So these things you can implement and you can get a good profit, but please have a proper paper trade, and then you try to understand the concept, then have a very Slow trading, do not use too many lots, use the stop loss, and then I will advise, if take a training, proper live training also if you required, then you go ahead. Definitely you have a profit also, and this video is for your learning purpose. In case of any doubt, I have shared your mail id, mobile, whatsapp number. You can contact me. Thank you friends, good night.